There we go. There we go. Evening, everybody. We're gonna go ahead and get started.
Can you hear us?
Yeah, I think sound is good. I think
Okay.
sound is good. So we're gonna go ahead and get started. Again, thank you everybody for joining. I know others will see the recording later, which is fine. We just wanted to do a free introduction to crypto, kind of share with everybody what it is, to have an understanding of how to get involved and kind of the aspect of how it all began. And from that point, then see how, where are the areas that you could participate in. It is a very new industry, a very new asset class by itself, and is a very important infrastructure now to our future, where cryptocurrency is going to be and as already making its way as the predominantly the predominant monetary system, and it's affecting everything. It's changing everything, and so we wanted to kind of give a free introduction class so that when we start discussing other things in the future, or when you see different things in the future, then you have an understanding of what it is, where it came from, and how it functions. So that way you could participate in the opportunities in it. So we'll go ahead and get started. Hope everybody's doing well this evening. All right. So we'll go ahead and get started here. And we'll go from, again, Key and I been married for 12 years, been together for a while, but we had the opportunity to come into crypto. We've been married longer, 12 years now. Anyways. So we were started with a family member who introduced us to crypto. And it was something that we were like, okay, yeah, we'll dabble in, got involved in it, and invested in it, and it became something substantial and significant for us as far as our understanding of it, our part of our investment strategy for the future. And thought, we took it from there to say, okay, well, we need to share this information with others and kind of teach on it. And so we're going to grow from this place and doing the introduction and the beginners class, and then from that place kind of go into the deeper aspects in the future
Yeah.
of what crypto is. So let's go ahead and get started. You have anything to add?
Well, yeah, and I think our first investment was back in 2015 or something, 2016.
No, it's 2017 is when we did some. You probably 2016.
Yeah,
Yeah.
2016. Did something like an XRP and XLM, and that's where the curiosity sparked. And so this is where we're at today. And so basically, we just want to be able to share full throttle what we've learned along the way. Cryptocurrency is very extensive, it's very wide, it's very deep. So this is just the first layer of cryptocurrency. And we're excited to share what we have so far.
Yeah. So we'll get started here. All right, going to the first. Let's explore this new world of cryptocurrency. Again, it's what we discussed. It's just a whole new asset class, a whole new monetary system that is coming forth in our time, and so it's something that we definitely want to not ignore and be a part of. So we're going to be discussing here in this class. We're trying to keep it condensed to about an hour, hopefully. But if we go over, we go over. So we're going to be discussing what crypto is. We're going to also be discussing the crypto exchanges, crypto wallets, and then also just talk about the opportunities in crypto, how you can get invested, what is actually changing, and how it's affecting our world today. All right, so we're going to go ahead first in what is crypto, and we'll be discussing fiat versus digital currencies, what the blockchain is, and then the old versus new markets that are available today. And so firstly, the fiat versus digital currency. So we'll discuss really quick. I'll discuss the history of currency.
Right.
So the history of currency, it derives from the Latin word to flow, or current. And it actually means a flow of movement of an exchange. So currency is like current of water, and it means to flow or to move. So currency itself actually was given the place for 3000 BC when it actually was first recorded. Currency was in the form of what we know as commodities today, but back then it was the form of beads, the form of shells. And what happened was these cities, these nations gave value to these objects because they represented some form of wealth, and they were exchanged as trade. So beads and shells were the first recorded use of currency about 3000 BC, where there was an exchange for goods, for food, for different products or commodities that others use, and they use beads and shells to exchange those things. When we fast forward to 700 BC, the introduction of coins in modern day Turkey, or the city called Lydia, is where we first see coins. And so, of course, we all know what a coin is. A coin is a metal that is formed into some form of currency. Where we have, today we have dimes, nickels, pennies
made
here
of
in the
silver
U.S.
or copper or
Yep, silver, copper. They used to be gold, but they're different types of metals, but they represent, currency. And so you can exchange this piece of this weighted metal for, again, food, again, grain and supplies, whatever else was needed. And it was in 700 BC. So we moved from that shell and beads to the introduction of actual coins, which we, been using for quite some time now. Eventually, it's already phasing out. Jumping forward 200 years. Jumping forward 200 years, the Romans introduced what they call the denarius, which is the standard silver coin. And so that's when we moved into what we see today. So when you look at the dime, the nickel, and the quarter, they're silver. And we used to have silver dollars here in the U.S. before they phased those out as well. But we're moving into the more modern styles of currency. In the 11th century, that's when we actually saw, so the year 10,000 to 10,099, we saw the introduction of paper bills, and they were exchanged and used in international trade in Europe. So essentially, we jumping from 509 BC to an additional 500 years in the future. We used the use of coins was going on. When we jump forward 500 years into the future from 509 BC, paper exchange happened over a course of period. So essentially what happened was the travel of metal. So when you're moving about and you're carrying currency and you're carrying coins and you're carrying these different things, that becomes a burdensome problem because you're heavy. It becomes a burdensome problem because of security risks. Security risks with that as well. And so when you have those things, you have to have protection. You have to have something when you're traveling to protect your assets. You have to protect yourself, and then you also have to have the means to transport that. Well, because that became such a burdensome problems, you got banks were generated. Banks were created to fix this problem. A bank essentially holds your assets, holds your resources for you, gives you a note, or what we call the currency, a paper note, saying this is how much you have in the bank. This is how much we'll hold for you. We'll charge you a small transaction fee to hold this. And then you can actually then hold on to this as a register. So when you come back, you withdraw some of your resources to actually transfer and use in business. Well, what happened is these merchants and these governments begin to just exchange the notes. And so when they made a deposit, they would write a new note or actually use the note that they've gotten to exchange for goods and services. Like this note, it shows you that my resources are being held at this bank. Take this note, and then you can go and exchange or withdraw the currency there. And so that's where we see that move into paper currency because it became a problem in transportation. So going forward from that point, we're going from 10,000 BC all the way. Then we jump another 900 years, into where now we're in the 1900s, where we then see 1913 is the start of the Federal Reserve here in the United States, created by private bankers. The Federal Reserve then from that point actually got cousins around the country. Yeah, where you end up seeing the central bank of, the British central bank. You have this is well before the European central bank came into play, but you had other nations starting their own central banks. And so central bank is essentially a bank that prints, monitors, and controls the currency flow in a country. So the central or the Federal Reserve there's 13.
13.
Yep.
Sorry.
No, you're right. Families. You're right. 13 Federal Reserve branches here in the United States. Minneapolis houses one, and where these reserves hold gold, hold resources, and print money. And they actually, you can see it on the actual bills that they note which Federal Reserve it comes from. Well, again, the Federal Reserve is a central bank, and a central bank controls the flow of money. They print the money, they reduce and increase the supply of money, and that was their job. And so this was established, and here in the United States, it's established by private bankers. J.P. Morgan Chase or Piermont Morgan was one of the bankers during that time. Then you had, all of the other ones, Wells Fargo's, the original bankers of from them. They also were a part of this conglomerate that started central banks. So in the United States, the Federal Reserve is not owned by the United States government. It's not managed by the United States government, and is not overseen by the U.S. government. It is only private bank. It's a private institution owned by private bankers that control the currency of our nation, not the United States. So the arm that controls money in the United States, it's only an accounting firm called the Treasury. So United States Treasury is only thing that has anything to do with money. They manage the taxes, and they control, or they monitor the transactions in the nation, but they do not control the money. The Federal Reserve and the central banks of the world control the money, and they are owned by private bankers. So moving forward from that point, we actually had at that time, we had 2 world wars. We had the actual dollar. The U.S. dollar became prominent after the Second World War, and it was backed by gold. And being backed by gold means that it had value. So everybody else backed their currency by dollars because the dollars were backed by gold. So they didn't have to actually put assets to their currency. They actually backed it by the dollar, because the dollar was, at the time, the United States was a superpower, and a global superpower from out of World War II. And then from that point, the rest of the nations, once you had during that time, just after, in I think the early 40s, you had the Bretton Woods Exchange that set up the gold standard here in the United States. You also had the at the end of World War II, you had the International Monetary Fund, the IMF was created. You also had the United Nations councils. All the UN was created as well. So all of this was birthed out of World War II. What we see today that governs and runs the world. Jumping to 1971 from 1913, Nixon got rid of the gold standard. So money was just being printed, because we were in the middle of the Vietnam War, losing money and losing that conflict. And then on top of that, we were into higher inflation. And during that time, the only way to print more money was to not have it pegged to the gold. You can't print more money if you don't have gold to back that money that you're printing. And so we had to, so he's temporarily suspended or indefinitely suspended the gold standard. And so now today, what we call fiat means fake, fictitious, a form of. And so that fiat currency is actually backed by nothing but the good old ingenuity of the United States, which we've lived here long enough to know what that means. And then so now we move to 2009, 2007, 2008. We have the banking crisis, where we have the what is it called? The banking crisis. The mortgage crisis. Where you want to talk? No, okay, the mortgage crisis essentially is that we got to a point where the housing market got to such an inflated place where any and everybody could get a house at any house. If you had a pulse, if you were breathing, you can get a house. You get a house. Yeah, you can have it. And the problem was people didn't qualify for what they were getting for. They couldn't afford it. They didn't have jobs. They didn't have anything consistent. And so the subprime, which essentially subprime means that we're selling houses to low qualified individuals who have bad credit scores and no serious or consistent income. And you're giving all of these properties. Well, we had the sub mortgage housing crisis because eventually when the market peaked and all of these balloon mortgages came into play, all of the actual monthly payments say, okay, now it's time to pay for your first monthly payment. Nobody can afford it. A lot of people could. They were on balloons. Balloon mortgages, just predatory lending. And people couldn't afford it. So they would just get up and leave their house. They would just walk out. They wouldn't even say, oh, give me some time. Some people will call and give me some time, give me an extension. But most people just abandon the property altogether.
Yeah, there were some documentaries on that where banks would go and knock on the door and they see that they've already left. And there were a lot of vacant homes during that time.
Absolutely. And that's, you have cities like Detroit who got hit hard. You have cities like South Florida and Miami, not everywhere, but South Florida, Miami got hit pretty hard. Michigan, there's a lot of different cities where these, once the housing market crashed, it took jobs, it took retirement and investments, it took income from a lot of people. And the United States government bailed out those who made the most money. So the banks that are too big to fail concept came into play, where they said, you can't do this to our people. Take this $500 million bonus, you can't work here anymore. And so they were kicking the CEOs out with these called golden parachutes, where they have lifetime retirement, lifetime pensions, bonuses, and payouts what they were owed under contract, and moved them out. And so they couldn't necessarily be the CEOs of these companies anymore, but they weren't going to jail. They were just getting paid to get moved out. And then the government came in and bailed out the banks. Yeah, I'm sorry, just seeing your message. Yep. So yeah, the Federal Reserve is government owned and not government owned, private bank owned and private bank ran. So it's very interesting. Some of that stuff is on Wikipedia as well, but there's other research and documentaries out there as well that will show that. But with the and I'm gonna wrap up here. We're gonna move to the next part. But with the sub mortgage crisis,
it was attached to people's retirements, and however
yes.
the advisors set it up, people were losing about 40% of their retirement because they put it in a package mutual fund where it had those homes in that, because it inflates. Of course, homes supposed to rise, and you're able to pull monies from that. And so a lot of people's retirements, even 401ks with employers and things like that, they were all tied up in that. And people literally lost 40% of their retirement in a matter of what?
1 year.
1 year.
So the market peaked in 2007, the end of 7, crashed in 2008, hit the bottom in 2009. And then we took, I want to say 5 to 7 years to recover after that. But the biggest takeaway with that is two things. The first takeaway is that the ones who were hardest hit were teachers, firefighters,
really
government workers, union individuals, those who are just blue collar. White collar didn't get. I mean, like white collar lost their job. So your office positions, your administration positions, everybody was affected in some way. But yeah, so the biggest ones that were hit were the ones in their pensions, bus drivers. I mean, just the ones who are doing that. So what came out of that is Bitcoin. Bitcoin was created out of that collapse in 2009 as a response to the corruption, where those who destroyed the economy got a bailout, and those who didn't destroy the economy lost 40% of their wealth.
Yeah, so the retailers are just the common people. We're not a big bank, we're not a big institution, we're not a hedge fund firm or anything like that. So it only benefited the corporations, really,
in the mega wealthy,
right? And so that's, like Dustin was saying, that's how Bitcoin came into play as another means of investing.
Yeah, and we'll dig into it more. Bitcoin was created in 2009 as a response to the corruption. Bitcoin allowed people to actually put their money into a different currency and exchange with one-to-one without the intermediaries. Bitcoin removes the banks and allows you to trade from yourself to someone else and use actual buy services and buy goods. So remember, when we started, we were exchanging shells and beads. Fast forward all the way to 2009.
Or hay or cows.
Yep, exactly. So fast forward now to 2009, all the way back from 3000 BC, and you're using digital currency to exchange. And so what happens is it's a store of value. If my money is in Bitcoin, then if the crash of the dollar happens, if corruption happens, if bailout happens, my money is not tied to the US dollar. It's tied to a different form of currency. And then that currency is worth something to exchange. And that's what came out of it here. So let's really quickly recap, because I went through a lot and we discussed a lot here. This is a slide where it shows the purchasing power of the dollar from 1913, when the Federal Reserve was created, all the way to 2013, which is roughly 100 years. And so it shows the buying power of the US dollar. And we have lost roughly about 99% of the value of that currency, 95% of the value from all the way to 2013. This is inflation. So what happens is when you're printing more and more and more and more and more, it becomes worthless. Here's the area right here. 1944, gold standard was created. 1971, actual Nixon removed the gold standard, and the value just continued to go down. And this is 2013. We were 10 years out from this point. We're in 2023 now. And so you can imagine how much more the dollar has eroded.
It's eroded.
It's eroded to the point where there's 27 nations applying to be a part of a different financial currency system. There's 27 countries who are now trying to be part of the BRICS nations monetary system that they're establishing because of the erosion of the dollar.
So what are the BRICS nations?
It's Brazil, Russia, India, China, and South Africa. BRICS. We don't have time in this discussion. We'll have more discussion on it. But essentially, there are nations now, headlines everywhere, that countries are dumping the US dollar and forever moving to another currency and the next currency, or the next forms of currency, which will be digital and which will be another superpower that is not the US. Here is another slide. This slide shows how much money was printed from 1990 all the way until 2020. And so what we see that 21%, because of the pandemic, 21% of all US dollars were printed just in 2020 alone. So let me show you this line. Each line represents $1 trillion. And so we're literally right here, just above at $21 trillion were printed in 2020 alone. This is for the last 20 years. So 1990 to 2000, 2000 to 2010, 2020. So this is 20 years. I'm sorry.
Mm-hmm.
Yeah. So this is yes, 20 years.
And didn't we just raise the debt cap?
Yes. So we raised the debt ceiling of how much debt our government
just
actually.
Recently.
Yep. Just because we don't want to default on our credit. But this shows essentially the erosion. So remember, the more money you print, the less valuable it is. And so in 2020 alone, we printed out of the last, since 1990, literally since 1990, the most money we've ever printed in all of printing since 1913. And so this is the reason why the fiat currency is a problem, why we're moving to a digital currency, why we're moving to a digital system, why we're moving into crypto, is because the corruption and the printing and the inflation has gotten to a point where it's unrecoverable. And I think that was, you want to talk on this one?
Oh, yeah, I can talk on this one. So back in 2020, when they were doing the stimulus checks and things like that, the CARES Act, I guess it took someone to kind of comb through the CARES Act, which is really stacked of like thousands of pages. And they saw how they was just trying to sneak this in. So in 2020, they were going to give the stimulus payments via the digital dollar. So they were getting ready to push out this form of currency back in 2020. So if you think about it, we weren't even ready for that. The American population was not even ready for this. So they was about to sneak this in. And because somebody whistleblowed and said, hey, you know what is this? Like, we have, like, you're going to give direct stimulus payments for families, like, and it's a digital dollar, so they ended up pulling it, but we were able to get a screenshot. So that's why we're showing now that if you look at yourself going from 2019 into 2020 with the pandemic and everything, where would we have been? Like, we were already in a distraught place, but when it's dealing with your finances and now things are converting over from paper to digital, what are you supposed to do with your paper? Like, my money in my bank, like, does that even count? So just think of where that world would have been if they would have pushed this through. So
yeah, absolutely. I mean, the concept is we have our current money system where we have cash and we have what it's worth. They were like, oh no, we got a new money, we got new dollars, we got a new currency. We're just going to sneak it in and give people the new
and
money
give you
and
stimulus
switch
check.
over people overnight. And it's like, well, wait a minute, this is new. We've never used this before. This has birthed anything. And it would have happened seamlessly under the radar, and we would have never known.
So there's people in the know, and there's people who that would have no idea.
Yeah.
So the ones that will benefit for this are the ones that are in the know.
Yeah. Yeah, absolutely. Absolutely. So that's where we are with the history of crypto. Not crypto, I'm sorry, currency. And now we're going to move into what the blockchain is. And we're in this part here.
Actually, I'm just going to explain the the portion of how we went from paper to where we are now, and then we're going to go into the blockchain portion. So um, when we look at how money evolved, I mean, I could go back to, just us having paper dollars, and then from paper dollars we were able to write a check. And so when you're writing a check, you keep your own ledger, so you get your pen out. I mean, I've heard people say, hey, I got to balance my checkbook, I got this money in and I just went and bought groceries here, so let me minus that. So you kind of kept your own physical ledger with your checkbook, um, that the bank actually give you. And then from there, we evolved into a credit card, or credit card. And if you remember back then, they would actually put it on this machine and then swipe it. So then it captured your numbers.
Yeah, and the information on there.
And your information. There was no chip or anything on it. It was just, they just swiped it and you got the yellow copy or something like that, or however.
And then they would manually go put it into the computer.
Yeah, then they would manually put it in the computer, right? Later. But you still had to keep a ledger for yourself, right? So then from there, we went from that to online banking, you had online checking accounts, savings accounts, and you got a debit card, you got a credit card with a chip. So we evolved from checks to the credit, and you still had to keep your ledger, and then online banking with a chip. And so now your bank was electronically doing your own ledger. You didn't have to do it. All your transactions were there. You didn't have to manually get a pen and do that. And then from there, if you just see the trends, we went from that sense to the chip to now it evolved. Now you're able to make transactions with your phone. You're able to put everything on your phone. You got Apple Pay, you got Google Pay. Just look at how money is evolving, in a sense of going from paper. Now they're getting us onto digital platforms. So now we have online banking. We're able to get on our laptops or our phones and things like that. Now we're able to tap cards now. We don't even have to stick it in there and let the card read the chip. You can do a tap. You can go from a tap to just using your phone to pay. And then now, if you want to send somebody money, you have Cash App, you have Zelle now, digital, all digital. People can get money instantly now. And so when you put it all in perspective, what is next, right? If we already know the form of the dollar is deteriorating, we are now transitioning into the digital world. So what they did was just gradually got the population to get grafted in. You weren't necessarily forced, but they just snuck it in, and it's going to continue. So now, from doing the peer-to-peer, Cash App is peer-to-peer, Zelle is peer-to-peer, Venmo is peer-to-peer. We have Fed Now. So if you already know the dollar is changing and that how things are trying to pivot into the digital world, which we're already there, what is the next step, right? If they already presented the CARES Act and was about to sneak the digital dollar in, so what's coming next? Like when you put it in perspective and you see the chain of events and you look at the world as a whole, you see where we're going. So we are now with peer-to-peer transactions. Some of the new global currency, of course, is the peer-to-peer, so the Zelle and Cash App. And now there's a crypto called XRP, which is revolutionizing the banking system. So if you think about it, the banks still want to leg in, right? So how are they going to convert into the digital world? So XRP is coming into play as far as that, getting the banking systems, all like Bank of America, Wells Fargo. I think they had piloted this back in last year, November, December. It's a news article, you can search it out, that they are going to be introducing a digital wallet. which we'll get into and explain that. And then also, the other thing is now a lot of platforms, a lot of companies, a lot of retailers and things like that are trying to merge over into Web3. And Web3 is the world on blockchain. I could tell you from just where I work on the medical sense is that they're they're converting over to Web3. And so Web3 allows you to be able to pay your bills or pay your medical with uh, with crypto, digital dollars, and things like that. So a lot of these companies are getting themselves prepared, but they're not necessarily telling the public. And this is what we're here for. So, oh, okay. So we're going to talk about the blockchain technology. Just like I was telling you um, how we evolved with ledgers. We did it physically with a check. We went from doing checks into online banking, where the bank kind of housed your transactions, and you were able to kind of sort and do it that way. We got Mint now that will take everything from all across the whole spectrum of that can house your transactions and things like that. So with blockchain, just think the same way, except that it is a digital ledger similar to how the banks keep it, the centralized banks keep it. Um, the digital ledger records all your transactions. It cannot be altered. It cannot be deleted. Transactions are stored on blocks, which we're going to explain that. Blocks have a signature that links itself to the previous chain. So we're going to break down what a blockchain is. And I think there's a slide for that. Okay. You want to explain this one?
Yeah, I could be quick about what that is. So essentially, here the blockchain itself is a block is the easiest way to explain, like Takia was saying, a ledger. It shows a number of transactions. So if I sent Bitcoin to you, and that's one transaction. If somebody sent Bitcoin to me, that's one transaction. Each block has a certain amount of transactions it holds. Well, the block itself is then, once it reaches a maximum of how many transactions it holds, it creates a new block. But there's a signature in the block. We can consider it a social security card or a social security number. I'm sorry. The signature in that first block is then imprinted on the second block. And so when the new block comes, everybody looks at this new block, because again, the digital ledger in crypto is everybody can see it. That's why it's so beautiful, because it's completely transparent. There's not an exchange. Now, you won't know that it's me unless you know my wallet address, but it's recorded for all to see. So
worldwide,
globally, and everybody can see every single transaction. And so you can verify your own if you want to share that information. But essentially, it's open to the whole world. So there's no hidden secrets. The people know where money is moving, where it's, and how it's moving. So the first block social is imprinted on the second block social, so you know where it came from. And so that's the chain. And so when the new block creates, say, for example, 1,000 transaction or 10,000 transaction, it's finished.
In the ledger.
Yep.
It's a ledger.
Exactly. The ledger of transactions. Then the actual number on that second block, the social of that one, is imprinted on the third. And so it's always connected. It's a chain of information that is never broken, can never be changed, can never be altered, can completely transparent, so that there is no corruption. That's why Bitcoin was created on a blockchain, so that there is always transparency. There's always global reviewing. And it's completely available for everybody to view it. And it cannot be manipulated. It cannot be broken. The chain can't be broken. The chain can't be altered, because it's being verified by the globe. It's not just one person saying this is a real transaction. You have millions of computers around the world and millions of participants around the world also verifying that transaction is legitimate.
Right. So if you think one world, you could look at this as a one world currency.
Yeah.
So how Dustin was explaining that with the block, it's a block of ledgers. All the transactions from the last transaction is linked to the block number 2 with a chain. So that's blockchain.
Yeah.
Anybody have any questions about that, or
Yeah, if you have any
make sure
questions,
just put the questions in there if you have questions.
definitely chime in. We're yeah, definitely chime in if you have any questions. We'll go ahead and answer it as we can as we're going through the different slides and moving into the next. And so,
Okay, so we have a quote here. The right way to think about the blockchain is that it's going to replace the entire internet, and that's by Brock Pierce.
yeah, that's Web3 that you were
And that is Web3. So that's on a totally different level, because what is happening is that with Web3, it allows you to connect your wallet, it allows you to pay for things, and then it also, with Web3, it includes the metaverse, where you're able to go into a digital world, and pretty much do the same thing you would do in a natural world. So that everybody is prepping themselves for that. So, which we'll get more in depth later on in other courses.
Yeah, for sure. And so we want to just really, I want to share this really quickly here. So BNP Paribas is one of the largest banks in France. It is a multi-trillion-dollar business, a bank. And so this article just came out not long ago this year, May 5th of this year. And so what they're saying is they're actually linking their they're linking their bank accounts to the digital yuan. So what that essentially means in this case, and so we want to highlight real world activity. China has created a digital version of their Chinese dollar. So the Chinese dollar is called the Chinese yuan, and they actually have gone away from paper yuan and created a digital version, which is not even the same thing. They didn't just make it where it's computerized. They got away up from their entire monetary system and all of the support structures that they have, and they moved to a digital yuan. What that means is that the central bank in China owns all money. So everybody banks with the central bank. Everybody's doing dollars, Chinese yuan with the central bank. There's no more. The banks itself are eventually going to be obsolete, and you're going to have the central bank that does all things bank do: lending, financing, moving and transporting of funds, moving it back and forth. Right now, the banking structure is becoming obsolete before our eyes because the digital yuan all is going to be ran by only one bank, which is the central bank of the Republic, or the People's Republic of China. But here's the catch: French banks are connecting themselves to the Chinese yuan, which allows their citizens to do exchanging, purchasing, using, transacting in digital yuan, and they're part of the European Union. So this means that they're pulling away from the euro, which the euro is going to have their own digital dollar, which is called the digital euro.
Yeah.
And they're then also not even involving the US dollar, when French is one of the oldest allies. France is one of the oldest allies of the United States.
Mm-hmm.
And they're pivoting to use digital yuans instead of European Union, the euro from the European Central Union. Or from the ECB, which is the European Central Bank. So it's happening now. It's happening before our eyes. And not only are countries moving away from, the US dollar as the dominant currency, we're also moving to a digital world, and we're also moving to another superpower, which is China.
And that was back in May.
This was this year.
May 5th.
Yep.
May 5th.
And there's so much that has happened since this article that we'll share more, but it's been so much.
Yeah, countries are moving very rapidly. So even as we're sleeping, things are just being passed. People are pivoting. Companies are pivoting. Everyone's preparing themselves, and we have to do the same.
Yeah, absolutely. I wanted to share really quickly, going back to we were talking about what is blockchain. There's one thing that is very important about blockchain, which is very significant. You should know this. It is actually the security of blockchain. And so cryptocurrency is that short for encryption. So crypto is cryptid or encryption. And so it's encryption. And so I want to highlight really quick just to understand the level of security. that there is an encryption, because that's a significant point. You have cash. Cash is not encrypted. Cash is not safe. Cash is not. You have tons of banks, tons of scams that where people's banks are being hacked. Money scams, laundering, all of these things. And so in crypto, there's a significant portion where it's encrypted to protect against these things, so that people can not only have their capability of keeping their funds and protecting themselves from these things, but not also have to worry about government interference, government
or freezing
sabotage,
accounts, or like kind of like what they did to some of these
seizures.
celebrities and stuff like that, where they'll go to the ATM, and because
there's a unique, musical artist who had a
we're not going to say any
partnership.
names,
He had a contract with Adidas, and something happened, but essentially they got to the point where they locked down his Apple Pay and his Google Pay, even though he financially had the funds in the bank to handle any transaction himself. They didn't, because of control and because of what's going on, they locked down his ability to do digital payments.
That right there is an example. So if they're able to lock down his Google Pay, I didn't mean to say his, but Google Pay, couldn't go to the ATM or anything like that. That lets you know, like, when you're dealing with centralized banking, how much control,
absolutely,
and manipulation there is.
Yeah, it had nothing to do with anything. It had everything to do with personal stance and control. So let me briefly, just really quick, talk about the encryption in crypto. So Bitcoin is protected, and I'm gonna go. This is a really kind of over your head nerd out, but I want you to know so you understand it. Bitcoin is encrypted what they call a 256-bit SHA hash function. You don't have to remember any of that. You don't have to remember what I just said. Just know that is a very long encryption. And so what it means is the level that the military uses for their encryption on their communications and on their computer system and structures, or their virtual networks. This is military grade encryption. But the difference is that the SHA hash function provides a unique fingerprint. So what this means essentially is that this functionality of cryptocurrencies, the key or the encryption level, is two phases. You have, and we'll deal with this more in the wallet, but essentially it's a phase where you need a key to see everything, and then you need a key to transact everything, and they're not the same key. So it's essentially like I have a key to get in my house, but then Taki has a key to get out. I can't get out without her key. We have to work together to get in and out of the house. It's not the same thing. Now here's the catch. Here's the catch. That my key is broken up into 100 pieces every time I use it. So I use my key to get in the house, and then it's broken into 100 pieces, and I have to reconfigure my key, and it's broken up into 100 pieces different every time. And I have to reconfigure my key.
The probability of
Then open the door, and as soon as I open the door and get in the house, my key is broken in 100 pieces, and I got to reconfigure it and figure it out. Then to her key, it is also, every time we go out, it is broken to 100 pieces and reconfigured. That is the level of security and encryption that Bitcoin and other cryptocurrencies have that will allow, it makes it difficult for the federal government to come in and take your funds. Unless they have to forcibly do it by, search and seizure. They have to give us your keys.
And that's what is making, because the crypto space is open. I mean, it's been open. That's why they're trying to bring so much regulations, because they can't control it.
There's no way.
There's no way to control it.
Absolutely no way.
So what they can do is put FUD in the news. Laws. They can discourage the regular American person, or just any civilian or citizen, not to even look at it or use it, because they're putting it out in the media and saying, hey, crypto is bad or whatever. You don't want to do that. But then their foot is all in it.
Yes.
Their whole body is all in it. They're diving in it. But then they're telling the general public not to do it.
Yeah. And then banning banks and seizing banks that are allowing customers crypto access. Yeah, so it's wild. All right, so let's move forward. We're kind of pushing on time. We're going to go ahead and jump forward into the next part, which is the new financial markets. And so we don't want to keep you too much longer, but we do want to kind of break all this down so you have an understanding. So the new financial markets essentially are, what we live in today, the space that we live in these new changing times where everything is digital and moving very quickly. I mean, you have the introduction of crypto, you have the introduction of AI, you have the introduction of the metaverse, and all of these different things all at once. And so we're rapidly moving into a new entire world and a new planet. And so it changes everything. So the monetary systems have changed. So to understand the new financial markets, TradFi, which is versus DeFi. First, let me just explain TradFi. TradFi stands for traditional finance. Traditional finance is what we grew up with. Regular banks. You go into the bank. You do your transactions that way. ATMs. You withdraw your cash that way. DeFi stands for decentralized finance, and so what it does is remove the bank, and you are the place of the bank. And so
you are the bank.
There's a monetary system, and you insert yourself, and you are that bank in that monetary thing. Decentralized finance gives you full control of the finances in this new digital space. And of course regulators are going to try to restrict that, but it is what it is. So what we're looking at right now, traditional stocks like the stock market itself, in the TradFi space or traditional finance space, the stock markets, that's all we hear about. Banks, companies go public and they put themselves on the stock market. So, we have Apple, we have Tesla, we have Amazon, we have Google,
institutions.
Institutions, large companies get to a point where they make enough profits and they want to publicly offer their shares of their company to everybody else. That's traditional finance. And so in that space, you have companies who've gone public, and the market itself is only available to trade from 9:30 a.m. Eastern to 4 p.m. Eastern. You can only go through the stock market exchange. It's centralized. It's only one. There's only you have the New York Stock Exchange where most transactions happen. You have the American Stock Exchange where nobody knows about, and so you have to go through these centralized organizations to trade and exchange stocks. You have to give up all your personal information. They need to know who you are, where you live, how much money you make. Have you ever traded before? Your address, your family, your parents. Are you qualified? You're not qualified. And they need to know all this personal information about you before you can actually sell and buy stocks.
Like they'll say, are you a beginner? What do you consider yourself? A beginner, intermediate, or expert?
Yes. How many years of experience in stock trading do you have? How many years of options trading do you have? Are you conservative? Are you all?
And then they'll have a median, a minimum amount that you would need to even open a brokerage. And what they've been doing is just having these astronomical numbers where the common person really couldn't get in
for a period of time.
So
until we moved into that digital space. So now with cryptocurrencies don't trade 9:30 to 4 p.m. like the stock market. Cryptocurrencies trade 24/7, 7 days a week. Holidays included.
Oh yeah.
It doesn't. The crypto markets never close, never stop trading, never stop transaction. Here's where it's crazy, right? So you have the foreign exchange market, which is currency exchange. Currency exchange opens up at 5 p.m. or 4 p.m. on Sunday Eastern, 5 p.m. on Sunday Eastern,
they're open
and goes all the way to Friday at 4 p.m. and then stops. Now, if people are transacting money all the time, why is the foreign exchange market stop trading? But then you have the crypto markets that never close, ever, because it's digital assets, digital dollars that are not centralized, transacting on the blockchain between people from different countries all the time. The reason why it never closes is because there's not a centralized control mechanism
or institution
to stop it. Yeah, no institutions.
Yeah, centralized, which we'll get into and break that down. It's an institution.
Yeah. So let me fast forward. Stocks are public businesses. Cryptos are technologies based on projects. They're technology-based projects. So when you hear a crypto, like Ethereum is a crypto project. It's not a business. It's not a company. It's not a corporation. It is a project. And the project itself, this is what we refer to when you're dealing with different tokens or coins. The project is trying to create a new technology or solve a new problem
or world problems.
Yeah,
some of them are even
real problems.
Like there's some crypto out there that is dealing with purifying water. Taking ocean water and making it drinkable,
or taking your carbon credits and converting it to cash, into a form of currency where you can use it.
So like Dustin was saying, so like when you're dealing with the stock markets, it's more institutional based. Crypto is more project based, which is really cool because there are entities out there that are really trying to solve world problems.
Yeah.
Or just bring a new facet of technology out that is going to benefit worldwide. So again, like Dustin was saying, crypto is 24/7 and it's peer to peer, and you can transact with anyone around the world. So
Yep. 100%.
it opens the world just like how social media has.
Yeah, I mean, so let's look at it really quick like this. A business that goes public, say Amazon. Amazon is fixing, so they're coming up with a new product. What they're doing essentially is now allowing you to get quick access to products that you purchase straight to your home, 2-day delivery. So now they're feeding in, as a business model, trying to reach a consumer and reach this consumer faster so that they have the market share. Businesses in themselves are geared towards not necessarily not feeling a need, but feeling it so that there are more customers that come to them. They're driven by bottom dollar. They're driven by, product placement. They're driven by, filling a consumer's needs, right? So Tesla builds electric cars. They're innovative, but then they also know that, we're shifting away from, fossil fuels. When you deal with crypto projects are solving the broken pieces of our current systems and also creating new technologies to solve problems that we didn't even know we have. So for example, what Ethereum does, Ethereum in itself is a whole foundation of monetary system. And what it allows people to do is, like Takia said, people have built, medical companies have built projects on top of Ethereum's network, where now you can actually be in control of all your medical records. The doctor's not in control, the healthcare is not in control, the insurance company's not in control. You get to decide where your personal information goes, because there's a crypto that has created a technology where you have to give permission to release that stuff.
Right.
And you hold all of your personal information where they don't have it. So if they want medical records, they have to come to you for medical records.
They have to come to you.
It's not sitting on somebody's database that can be hacked. And so it's beautiful because that's what crypto is trying to solve. And so in different things in different places, tracking shipments better. There's just so many things that are coming out of the crypto space. And so a lot of businesses are now building on blockchain and trying to solve that problem. Let me be quick. The last thing here is cryptos move a lot more than stocks. They're a lot more active, a lot more volatile in a good way. And then also, if you manage risk well, it gives you a lot more potential. So quickly here, we're getting into our time. But the S&P 500, this is for 2021. The S&P 500 had an amazing year. It made 28.6%. The average is roughly between 7 to 11% a year. So the S&P 500 can average higher, can go higher one year, can go lower, but it averages over a 5 to 10 year period, roughly about 10%. And this is not including taxes, so don't forget about those. But it averages about 10%. So it did 18% more than its average that year in 2021, which was phenomenal. It's a really good year to be in stocks. Well, if you go over to just Ethereum, now remember, the S&P 500 is the top 500 U.S. companies in the United States. And so you're having to look at 500 companies that you have to manage and make 28%. Again, what an amazing year to be in stocks. But then if you look at Ethereum in the same year, even though, it's just now Ethereum is just one project. Imagine we're going from 500 to 1.
Yeah, and S&P, the financial advisors usually, put that in people's portfolios.
Yeah,
too,
it's recommended.
It's
so
recommended
for growth, financial, right. So the same year, the same exact year, the S&P 500 had 28%. Ethereum had 270% in the same year. So now remember, this is the upward trend of the S&P 500 over 2021, the whole year. We jump forward to 2021 with Ethereum. This orange line is that upward movement. This is the same line. This is the S&P, and this is still the S&P. But you can see that Ethereum had a massive move in 2021 and still came down from off of its highs. And it made a total from this point where it started at the same point from 28% on the S&P 500 up here. It made 270%. So essentially, long story short, is if you put, say, $1,000 in January, you would have made $2,700 on your $1,000, as opposed to $280.
Yeah,
is the
pretty
difference.
much.
And so you
Pretty
got an
much.
understanding of that. You can quickly explain what this is. I can break it down really quick too.
Oh, you could do that.
Okay, so back to what we were talking about, difference between TradFi and DeFi. TradFi essentially is this is the central bank, and this is where everybody connects. This is our current system. Everything has to go to a centralized organization, a central space of control, a central one that can suppress or oppress or manipulate the markets, the everything that we do. So yeah,
TradFi is traditional finance.
Traditional finance, exactly. Investors have to go to this central bank or the central banks. Lenders have to go through a bank that's connected to a central banks. Borrowers, industries, we all go through a bank, and the bank is connected to the central bank. Where in DeFi, everybody's not. There's no central. There's no central. You are this.
You are the bank in
so,
DeFi.
Yeah, and so you are the lender. You're the investor. So if you're dealing with an investor, you can deal with lending. You can lend or be a lender. You can be an investor, or people can invest in you. You can actually be an industry leader, or you can borrow. All of the things, you don't have to go through a central organization or centralized control mechanism that controls everything that you do. You have the freedom to do what you need to do in DeFi, and that's why it's a problem for governments.
Yeah. So typically, if you look at it in traditional finance, you go to the bank and you say, hey, I want to do X, Y, and Z with my money and with my dollars. And you go to a bank, which is an institution, and they'll do those things for you. On the DeFi space, everything that a bank can do for you, you can do for yourself in the crypto space, in the DeFi space. So it like Dustin was saying, it eliminates the centralized banking portion of it. So like how we say, oh, we're going to deposit our money into savings, but then, when it's time to retrieve it, the banks say, well, we can't give it to you in 3 days, because they're out trading your money and whatever, however. So just know in the crypto space, the things that the general public was not privy to, that the big institutions or these big corporations was privy to, because they got their foot in first. And then they're like, oh, we can't tell everybody this, right? So if you think about your schooling and things like that, they didn't tell you that, hey, you could do this yourself. They're just doing it for you. And you're coming to the institution, they're charging you a fee or whatever. But in the DeFi space, you can do the same thing that the bank can do for you. You could do it for yourself.
Absolutely.
So that's the crypto world.
I couldn't say it any better myself. All right, let's go ahead and go forward. So we're moving now into crypto exchanges. All right, so crypto exchanges. You want to hit this, or you want me to?
I could do the C5.
Okay, cool. All right, let's go ahead. So we're dealing with crypto exchanges. Crypto exchanges are essentially just what they're called. There's a centralized exchange, or an exchange is essentially where you buy and sell. It's also a centralized broker as well, where you're buying and selling from a centralized organization. So we'll jump into that and deal with the centralized side of.
So with centralized exchanges, as far as crypto, centralized exchanges is a institution that allows you, the user, you go to them to get crypto. So you have you're going to an institution. So a centralized exchange is centralized finance. Centralized finance means financial products and services offered by a company, a central location. So an example of a centralized company, you could say Coinbase, Crypto.com, Robinhood actually has crypto on there. What's another one? Webull has stocks and crypto. Yep. So when you look at those platforms, that is a centralized exchange. So centralized exchange is an institution where you're able to buy, sell, trade crypto, and they're housing it for you. So they're making it user friendly and things like that, and offering it out for the general public. The centralized exchange is a company that provides services, like I said, to buy, sell, and trade, and exchange your crypto to fiat, all on that space. So some of this, another one of the centralized exchanges is Binance and KuCoin. Like I said, crypto.com, and I think I didn't say Kraken is also another. Um, they're they have regulations and requirements, just like how you go to a Bank of America, or they'll say, hey, you know, like with banks, you got to have a minimum of whatever. If you don't have a minimum of this in your bank, we're going to charge you this much money. You know, so when you're dealing with the institution, they can create their own rules. They can say, hey, we could freeze your account if you violate this or whatever. So you're dealing with that. And then also with the centralized exchanges, you have to give your KYC, which is like your personal information. So they're going to want your name, just like how like Banks of America or Wells Fargo would want. They want your name, they want your address, maybe your social security number to be able to open up an account. That's what with the centralized exchange. There are 15 U.S. Financial regulatory agencies in every state that house their own regulations. With what is it, the Patriot Act? You can go with the Patriot Act.
Yeah. So let me just really quick explain the multiple. So in Europe, there's one financial regulatory body that handles 15 countries. One financial regulatory body that handles, they're called the financial, regulation. And they monitor they monitor the regulations and control of 15 countries in all of their transactions. Here in the United States, in our one country, we have 15 regulatory bodies that handle one nation. And then on top of that, every state, we have 50 states that have their own individual financial regulation laws and bodies. So we are dealing something in the ballpark of 65 different regulatory bodies in the United States that handle the money control depending on where you live at. As opposed to if you go to any European country, you deal with one. And the rest of the world does not have this problem. The United States has this oversaturated and over excessive amount of regulation in compared to anywhere on the planet. It's excessive, it's massively unnecessary. Gotcha. So going to okay, so here also United States, there's the Patriot Act because patriots are what our country needs. So the Patriot Act essentially is another control where 10,000, if you do anything $10,000 or more, you have to report it, and it's reported every time you do $10,000 transactions, every single time to the rest of the world. I mean, to not the rest of the world, but to the federal government. So they have to trace and track every dollar. That they have just recently passed a law that will be coming in the next 2 to 3 years. That $10,000 is now dropping down to $600.
Mm-hmm.
So every $600 that you transact anywhere in the United States will be checked by the IRS, and they will be reporting on it because it's their patriotic duty.
We did that at the same time.
Yeah, we did. And so yes, so it'll be $600 per transaction, just to let you know you can't run from the IRS. They will be watching, and they will be governing us as well. And and that's it. That's it. Yeah, that's it.
All right. So some of the benefits of go ahead. No, go ahead. You could talk about that.
Yeah. So this was a massive ordeal. One of the centralized cryptocurrencies called FTX, and this is the CEO, former shamed CEO Sam Bankman-Fried, SBF. Shame. Long story short. They lost $60 billion of investors' money by taking the investors' money and squandering it on very risky investments, and then losing it because they were using loans and leverage to do it, lost it and didn't tell anybody. And then somebody realized that they couldn't get their money, and the price of their crypto crashed.
That went down within a day.
Yeah. And
I think it was $99, right? A share.
It was per token. Per token. It was something like that. And it just completely collapsed because it's centralized, they are in control of the finances that you deposit with them. If it was a decentralized situation, the actual decentralized organization that manages their own funds would have to deal with that, and everybody else's funds would be made whole. If you put money in there, all your investment in there is still decentralized, so you're transacting, you still hold all your exchange. And so it was a nightmare of a situation. But you know how the U.S. federal government is. They say, yes, this is our opportunity. Regulation. This can't happen to the people. We have to protect the people.
But their whole body is in crypto,
Yeah, but
on the other end.
Right. This is a scapegoat. But anyways, we're moving on to the pros of.
So the benefits of the CeFi, ease of use. You're able to change your dollars to crypto or from crypto to dollars. They do have a customer support. And of course, there's the easy swap conversion, like I just said, from dollars to crypto, crypto to dollars.
It's a simple application.
Most of them they try to make, of course, they want everybody to be centralized. So what are they going to do? They're going to flock everybody to the centralized portion because it's user friendly and they got customer support and all that stuff. So just give us your money. The cons of CeFi is there's no privacy. You got to give all your personal data.
Social security.
Unlike how Dustin explained this, it can get hacked, of course. Mm-hmm. Transparency is not available. There are higher transaction fees, just like how banks can charge you, and just say, hey, we want to charge you $5 a month if you don't have a certain amount in there, or however. The custody of user. So how Dustin was explaining, which we'll get into as far as wallets, if it's you don't necessarily own these funds. Like when you read the fine print and all that stuff and how they're able to freeze your account and things like that. So not your keys, not your crypto.
Yes. Remember that.
Not your keys, not your crypto. They, of course, they have censorship, kind of like what we was explaining before. They could just blackball you. Blacklist you. And
they say the government told us to do it.
Freeze your assets. Didn't they freeze you?
They didn't freeze him. So I had a situation where I was doing some business with Coinbase's Visa card, and they said you violated one of our issues. And I'm like, well, yeah, okay, what did I violate? I can fix it. We can't tell you. We just violated it. But you can still use us, but you can't use our card. And so I stopped using them altogether, period, because no thanks.
Yeah, because we were using, so Coinbase had this thing where if you did their debit card or their card, you know how like you can use your American Express and you get reward points. With Coinbase, if you just went to the grocery store and you used the card to maybe buy groceries, I think we were trying to get, so our exchange for the dollars that we spent was to get XRP, I think it was.
You get crypto back.
And when you have children and things like that and family, you're going to the grocery store all the time. So, we're always just trying to be very savvy, with our money and things like that. And so we were like, oh, that's beneficial. We are, at least when we go grocery shopping, we get something back. And so they saw how we were.
It was like
doing really good on that. And then
it was like, no, you violated.
You violated something, but we're not going to tell you what you violated.
Can't tell me.
So those are some of the things that you may deal with, or you may not, on the CeFi. But the CeFi is user friendly.
Yes, it's the main point of centralized finance, like Coinbase, Binance, KuCoin, is on ramping your fiat currency into cryptocurrency. So it's the best place to change your cash from out of your bank, off your card, into crypto. You can't typically do that everywhere else. So that's what the main focus is at for centralized exchanges. You want me to hit this decentralized exchanges? You want to go ahead and hit the decentralized exchanges?
I could do DeFi.
Okay, cool.
So DeFi stands for decentralized exchange, where crypto can be traded, swapped, staked, loaned globally via peer-to-peer transactions without a middle organization. So it's peer-to-peer. DEX, or decentralized, stands for it. Like when you see, so we're just trying to give you some language or to understand the language. So when you see DEX, just know that it stands for decentralized exchange. It is where global participants can come and swap crypto with one another. So it's kind of like peer-to-peer, like Cash App or Zelle. Um, with DeFi is not regulated by any U.S. or international regulatory body due to decentralized autonomous organization. The ownership of these exchanges fall into the body of global participants. Um, it's trustless. Trustless means that participants don't have to trust a person or a company integrity because of the decentralized application. It is encrypted, complex, algorithmic, smart. It's a smart contract that allows two participants to exchange crypto between one another upon agreed.
I want to quickly explain what that means. So in DeFi, when I want to send you crypto and you want to receive crypto, I just need your public address. I don't need anything of your keys or your privacy. So when I want to say I want to send you $100 in crypto, I send this $100 in crypto. The intelligent algorithmic smart contract, which essentially is an AI that is very not only transparent. You can see the code for those who know how to code. You can see the code. What it does is says it's no middleman, no middle person, no middle human. It literally says, did this person send the money? Yes. Transact. That's it. There's no person saying, well, I don't like what country they come from, or I don't like, they're this
like
or they're
that,
or you know what, we have to monitor them because of that. There's no centralized anything. So the smart contracts that allow us to transact say, was this satisfied? Yes. Was this satisfied? Yes. Boom, done. And that's it. And then the whole entire blockchain network of miners and with the stakers, they verify the transaction. Thousands of people say, yes, this is legitimate because the smart contract says it was met. We see it. Boom. And you have to get, depending on each blockchain, there has to be 9 verifications, 12 verifications, 15 verifications, 40 verifications. Every blockchain is different, but you can't just, when you send money, there has to be multiple verifications that this is a legitimate transaction from all these anonymous individuals
all over
around
the world.
They verify that your transaction is legit, and they get a commission, a small little commission to verify that. It's not a lot. It's pennies on the dollar. They verify it. And then when they verify it, and 9 other people verify it that it's legitimate, then they send it and they record it and it's in the block. And so this all happens in instant milliseconds. And sometimes there's some currencies that could take up to 5 minutes to do all of this. But all you have to do is hit send, and then that person will get a receipt, and they'll get a notification that whatever they're using to say it was received, and that's it. And so the smart contracts are highly advanced, algorithmic, complex, encrypted mechanisms that just handle everything. Boom, 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 boom. Relay stations. No person, no humans, no derogatory, racial, insensitive individuals that control, no centralized, nothing. They just, yes, boom. And that's it. You want to buy, they want to sell. Hey.
And that's why banks are threatened. They're threatened by this technology.
They cannot control you.
They can't control you. And so what's happening is that if they don't get with the program or participate in some way, shape, or form, it's going to put the banks out of business. Just to continue, some of the benefits of the DeFi or the decentralized exchange is that they don't require your KYC or personal information. You remain anonymous. You are recognized by your wallet, and you can have multiple wallets, which we're going to get into. They have lower transaction fees, just like how Dustin said, it's very pennies on a dollar. You retain your crypto. You own it. You're the bank. Just look at it like you're safe. You have the keys. The decentralized exchange, they can't take your crypto into custody because it's not regulated.
Yeah, central exchanges, you have to send your money. So if I want to do some centralized exchange transactions, I have to put $100 on that exchange. When I do decentralized exchange, I keep the $100 and I exchange straight out of my wallet, and I keep my money. So anything else. So if I have $100 and I want to do $5 of transactions, then I just tell them, hey, I want to change $5 from my wallet to that wallet. So it's literally like sticking my hand in my wallet, giving somebody $5, and they give me the product. And I keep that product As far as a centralized exchange, it's like, hey, I want to buy that $5 product. I have to give them my $5 first. And then they're the middleman that goes to handle everything. I don't have to do that with a decentralized exchange.
That's a good example. Another benefit of the DeFi, you have access to all projects, all tokens. You have access to decentralized services that is not available on traditional finance or centralized. Again, there's no censorship or frozen assets, which we just talked about. You can't get hacked. You're the wallet
because you control your
you
capital.
control your capital. Some of the cons of DeFi is there are no regulations for scams or rug pulls, which I think that's the slide there. And it requires additional knowledge for cross-chain swaps and transfers. So that's where we come into play, because on the centralized exchange, it's very user-friendly. On the DeFi, there are steps to this whole thing to be able to navigate through the decentralized space. So you are your own bank. So now you have this whole financial world right in the palm of your hands, right? And so the things that you weren't privy to in the traditional finance portion, you have that whole world right in your hands. And so that's what we're here for, to help you navigate through the DeFi, because ultimately we want you to be your own bank.
Absolutely. Okay, so we're going to try to wrap up this last piece here with crypto wallets. And so we'll try to be quick. We do it within 10 minutes. So crypto wallets is the last piece of the puzzle. A wallet essentially is where you keep your money at. It's just simple. You have a wallet, you put money in there. Where there's in crypto is where you keep your crypto, is where you hold your crypto. So we're going to discuss what a crypto wallet is, how they work, and then the 3 types of wallets. And then we'll move on to the last part of this conversation, and we will be all done. So what a crypto wallet is, if we go ahead and move forward, the definition of crypto wallet is a program that allows you to store, send, receive digital currencies like Bitcoin and Ethereum. It uses a unique code to keep your digital currency safe and protected. And so essentially, again, it is a digital form of where you store your keys. You store your crypto and keep it in a safe place where you manage it and keep it in control. And so, here's how it actually works. So the first step is you're going to set up your wallet. Now, there's 3 types of wallets. Let me actually jump and then I'll move backwards. So there's 3 types of wallets. You have a cold wallet, you have a warm wallet, and a hot wallet. I'm going backwards to forward. I'm going to start with the hot, move warm, and then move cold. The hot wallet is essentially a wallet that is stored on the centralized exchange. So when I send $100 to Coinbase, my $100 is sitting in Coinbase, is in my hot wallet. It is called a hot wallet because it is connected to the internet. It is called a hot wallet because it's access to they hold your funds, they own your funds. So when you send crypto to a centralized exchange, they're in control of your funds, not your keys. They have the keys to that wallet, so they own it. So it's hot because it can get hacked. It's hot because you don't own it. It's hot because it's all of the ways that all of the things that could potentially go wrong sit in a hot wallet. Now, hot wallet is good for a reason because it's easily able to send your cash. You can convert your cash into crypto. That's why a hot wallet is good. But hot means bad. It means like don't touch the stove, it's on and it's hot. Don't touch it. So hot means kind of keep your distance from it. Use it, but then get away. A hot wallet, again, is the ones that when you have a single point of failure, which is a centralization of all the networks, a centralization of all the coins. If somebody hacks that centralized exchange, then everybody's at risk. You're not segregated. You're not separated. You're not apart. You're part of that. So if they get hacked, you get hacked. And so that's the problem with a hot wallet. The warm wallet is a lot safer than the hot wallet, but it still has its vulnerabilities. A warm wallet essentially is warm because it's still connected, because it's an app. It's on your phone. So there are like Trust Wallet is one, Ledger is another. Trust Wallet and MetaMask wallet. Those two wallets you download on your phone. You have your keys, and they're your, crypto. You custody them. So when you have your own keys, then they give it. And so what I mean by keys, let me take a quick step back. A key is essentially when you open up a wallet. Say you download Trust Wallet and you say create new wallet, it'll give you a key code password. It's not this random bunch of numbers and letters. It literally is words: tree, farm, house, car, bug, love. And what happens is it gives you 12 to 24 of these. Now, what we see is just different phrases, key phrases. What they actually are is one giant long letter of configured numbers and letters. So we see it in one way. It's actually converted a different way. So when we have these 12 to 24 phrases, that's our keys. And the combinations are so varied that all you need is that key. Those combinations of 12 to 24 never can be figured out. It takes millions and millions and millions and millions and millions of variations to figure out your exact keys. So never give them away. Never tell anybody. Keep them in a safe place. Don't put them on the internet ever. Because if you keep your keys, then no matter what happens to your phone, if you put your wallet on your phone and you lose your phone, you always have your keys. You always reinstall your wallets to any new device.
Yeah, and if somebody asks you for your keys, that should be red flags. When we first got into crypto space, we were on some of these platforms, and people were like, trying to get some technical help and things like that. And so they were going on these sites, and they were like, "What are your keys?"
Yeah, we'll help you find
We'll
your
help
lost
you.
crypto. What are your keys?
We'll help you find your lost crypto or whatever.
Or we'll send you these new crypto that just had this Zeus
Yeah,
launch.
just give us your keys. Do not give your keys
Ever.
Anybody
say, "Oh, what's your keys?" You say,
nobody
what keys?
needs them. Who needs what? The only reason why they want them is so they can have your wallet.
Yeah.
Because once they have your wallet, then they could change the past. They could change it.
Yeah, that's the key point. That's the key point here, is that to do everything in DeFi, you never have to use your keys for any of it. Yeah, nobody needs your keys to do anything in crypto. You don't need your keys. Once you set up your keys for your wallet, and then you don't have to set them up, you just get them. Yeah. You never have to use your keys ever again, unless you have to restore a new wallet.
Yeah. So like if you need troubleshooting and you're like, just say you bought a project or whatever, and you're like, hey, I'm trying to buy this coin from you or whatever, and if that's their technical support and they ask you for your keys, they don't need your keys. They just need to show you what you need to just do or tell you. So
yeah, absolutely. You never need your keys to do anything in crypto. Any transactions, any loaning, anything. You never need it. So one wallet is you download the app. It's an app stored on your phone, secure on your phone. Your keys are given to you. Nobody can access it. The only thing is, because it's on the internet, there's always a small risk of something happening to your device. And so if people get access to your phone, then they may have access to your keys if you store them on your phone. So you have to
if you store your passwords.
Yeah. So you just have to make sure that you have a safe place to store your keys and don't keep them on your phone. But this wallet is safe. This wallet has the ability to allow you to transact easier because you can move crypto to and from. And then this one allows you to also custodian because you have the keys to everything. So it's yours. Cold wallet is the safest wallet. It is also the slowest because it's not connected to the internet. So essentially a cold wallet is like a safe deposit box in your house, not at the bank. If you put it in the bank, you don't own it.
It's not your keys.
It could be seized. So that's the difference. A lot of people are like, oh, it's like the safe deposit box in the bank. No, the bank can steal your stuff by saying, oh, a government came in here and seized your assets.
Or we burnt down or something.
Yeah, or something crazy. So that's not what that is.
We got robbed.
Having a cash box in your house is the same as an equivalent of a cold wallet. Cold wallet never connects to the internet. A cold wallet allows you to keep your crypto off of any network scams, hacks, EMPs, and stuff like that. And it allows you to keep your crypto safe. So when Takia and I are investing, any crypto that we are keeping long-term goes into that vault in our cold wallet and never comes back out. Ledger is a company that allows that, but there's some other ones. There's Trezor, Trezor, which is another safe cold wallet that allows you, and they come into flash drives or different types of devices where you get the keys. They're heavily encrypted, and you can keep your stuff safe. And so hot is more riskier, cold is the safest way you want to go, and it's the safest way to keep your crypto. But again, it's not connected to the internet, and then also it makes it a little bit more difficult to transact off your cold wallet, because again, you want it the safest way. You want it to be difficult to get into on the cold wallet. Those are the types of wallets. So let me explain how the wallets work. You set up your wallet, you get your keys, and then you put essentially, once you put your keys are actually in there, and so once you're transacting, you get a public address for everybody to do. So that address allows you to send and receive. So people can send to your public address once you set up your wallet. If people get that, there's nothing wrong with that. They can't take anything out of that. That's where you send money. So your public address, or that's your public access key.
Kind of like your Cash App when you send
Yeah,
people. It's
it's
like,
exactly.
well, how am I
what
going
it
to
is.
how am I
What's
going
your
to send you money?
username on Cash App?
But except that it won't have your name on it. It just has like a serial number or
Yeah, it's a long
like
thing.
a
You just
code.
copy and paste.
Yeah, you
It's
just
simple
copy
to
and
get
paste.
into.
So just think about Cash App, and people are like, what's your Cash App? And people like usually
The QR
screenshot
codes.
the QR code. So it's similar to that.
Exactly like that. And so essentially, the way it works is, first, the step one is you set up your wallet, you get your keys. And you secure those keys. You get them written down and put them in a lockbox. The second part is, okay, now that you have that, you have your public address, and you want somebody to send you some crypto. You give them the address, and then they send crypto to your address on the same network that you sent. Step 3 is now that verification. We talked about miners or stakers verify that this transaction is legit. And in step 4, it is in your wallet. And that's how easy the transactions are in the DeFi. We're definitely going to teach on this more so that it's understandable about how it works and functions. But just know at the top end of the day that when it comes to crypto wallets, they are where everything transacts on the centralized and decentralized exchanges and places. And so that's kind of a breakdown, and we push through it because we don't want to keep anybody any longer. But yeah, that's the breakdown of the wallets. And then this is the last part right here, the opportunities in crypto.
Yeah, I can quickly go over that. This is the last portion of it. Just opportunity in crypto. So like what we just explained, you have the opportunity of investing in projects or coins. There is staking and yielding or yield farming, which I don't know if you want to explain, or we just kind of, and then there's trading, futures, and options. So pretty much everything that you could do on the traditional finance side, like we said, the world is open up to you. There you could do lending and payments. You can actually get a loan without having a credit check,
Yeah.
in the crypto space. There are just so much in this space that you're privy to. Then we get into the NFTs, games, art, and music, and things like that. A lot of artists, a lot of musical artists are actually moving over to the crypto space and getting their royalties. They're moving off ASCAP and BMG and moving over into the crypto space because those are institutions, which is a middleman. So think in the crypto space, it's just eliminating that middle person, and it's a peer-to-peer thing that's going on. And then also the metaverse, which we're really, really diving into. Apple came out with a new VR. So when you're thinking about this, technology is here and is moving very fast. So in the metaverse now, people are able to buy land. So what you see in the natural space, in the metaverse, you can purchase that land. So what people are doing now, and there's actual projects where you have your physical home that you bought. People are making sure that they're buying their metaverse home, their lot, they're buying it. So there's a lot of things going on. You've got Nike, who's gotten their patents because when you create your avatar, people are like, well, I need gear, I need Nikes, I want, whatever, however you want to dress yourself. And in the metaverse, you're actually able to go into these stores in the metaverse and actually make a transaction. You can actually make a transaction that can actually bring you the physical product to your home, and you can shop in the metaverse. So when you look at technology and where we're going and how it's feeding, it's just, you want to make sure that you get your whole both feet in.
Yeah, absolutely.
Yeah, you want to jump in wholeheartedly, because the whole thing is you don't want to be left behind, and then you don't even know how to calibrate. So this is what we're here for. So this is just the beginner course of this. It really goes into depth in the centralized space. And it really, really goes in depth in the DeFi space. So we just did the beginners just to kind of get you started. And we hope that you enjoyed this course. And I think in the future, we're maybe doing a masterclass.
Not a maybe. We're definitely going to do a masterclass. There's a lot more to go into, a lot more to teach on, a lot more to discuss. And so we appreciate everybody spending the time to listen. And those who are listening back to the recording, we hope that you get a lot of value out of this and really have the opportunity to kind of go deeper. And when we start getting into more investing opportunities, that you kind of get a good grip from this video to take that into the next space.
Right. And we're expanding from here. So eventually we'll have courses and things like that, and a just a community where we're able to just chat and be able to share information.
Yeah. So it's going to be good.
Yeah.
Again, thank you, everybody. You have a great night. We'll catch you on the next time.
Good night.